Hello everyone, Namaste. Welcome to today's Explainer. आज का topic is absolutely crucial. We are diving deep into accounting for GST, right through its complete life cycle. Honestly, whether you're managing accounts, tallying up your books, or just learning the ropes of finance, this is one core concept you simply cannot afford to mess up. So let's decode this entire process together and get those GST entries ekdam clear. Now, I want to kick things off with a slightly thought-provoking question. Why exactly do we account for GST so differently compared to our regular business expenses? Think about it. Normally, when a business pays a tax or some standard fee, it's treated as a sunk cost, right? Kharcha ho gaya, money left the bank, and it's gone. But GST, it is a completely different ballgame. It's less of a straight expense and way more of a matching game. We are literally matching our inputs with our outputs. How does that work? Well, let's dive right in. Here is the roadmap for today's Vishleshan. We'll start with the basic one tax funder, meet the GST family members, and break down input versus output GST. After that, we'll hit a little plot twist with reversing tax credits before wrapping it all up with the grand set of rules.
All right, jumping into part 1, GST basics, the one tax.
Do you guys remember the absolute headache of the old indirect tax regime? We had state VAT, excise duty, service tax. It was a total nightmare for accountants. 8 ke upar 8 tax lagta tha, creating this massive cascading effect. Enter our hero, the goods and services tax. It is a single, comprehensive, destination-based indirect tax. This whole one nation, one tax system finally swept away all those old confusing levies. But the absolute most important takeaway here is that GST is consumption-based. Tax sur value addition per lagta hai at every single stage in the supply chain. This guarantees that the final, ultimate financial burden falls squarely on the consumer, not the business owners. Moving smoothly on to part 2, let's meet the GST family. Now, pay very close attention here, because understanding this geography is the golden rule for your kata book. It's actually fascinating how geography dictates everything in this system. We are looking at 2 main scenarios. On one side, we have intra-state supply, which literally just means buying and selling within the exact same state boundaries. Let's say Mumbai to Pune, within Maharashtra. When this happens, the tax splits into twins. CGST goes to the central government, and SGST goes to the state government. But on the flip side, what if you cross state borders? Say, selling goods from Gujarat all the way to Uttar Pradesh? That instantly becomes an interstate supply. In this case, a single unified tax, called IGST or Integrated GST, is levied by the center. Just lock this in your mind. Your location entirely defines which tax family member shows up. Next up is Section 3, Input versus Output GST. This is where we get our hands dirty with the actual mechanics of recording these taxes. So what exactly is input GST? Simply put, it is the tax you pay when procuring goods or services for your business. Imagine you're a business owner buying a batch of raw materials. You pay GST on that purchase. In your books, you debit this input GST. Why do we debit it? Because it actually acts like an asset. Think of it like a cashback or an advance payment. It's a tax credit sitting there that you can utilize later against your future tax liabilities. Pura paisa waste nahi hua hai. It's a highly valuable credit. Now, contrast that with output GST. When you finally manufacture your product and sell those finished goods to a customer, you collect GST from them. That is your output GST, and it is credited in your books. Here is the crucial reality check. This money is absolutely not your income. You are simply acting as a collection agent for the sarkar. It represents a strict liability that you have to deposit straight to the government. Let's picture how this actually plays out with a classic double-entry bookkeeping scenario for a standard purchase within your own state. Notice how the actual purchases account is debited only at the net cost of the goods. The GST values, input CGST and input SGST, are debited completely separately. We never mix them into the base cost of the purchase. They sit in their own accounts as our sweet cashback credits, while the total gross amount you owe goes to the bank or creditor's account. Make them clear, right? Which perfectly brings us to Section 4, reversing the tax credit. Because let's face it, business is never perfectly straightforward. Sometimes unexpected things happen, and we are forced to reverse those input GST credits we just happily recorded. And trust me, if you miss this step, your CA will definitely catch it and your books will never tally. The main funda is this. If the goods are never actually sold to a final consumer to generate that output GST, you cannot keep the input credit. So if you return defective goods back to your supplier,
Reverse it. If the business owner takes goods home for personal use, reverse it. Handing out free samples to customers, reverse it. Goods tragically lost in a fire or stolen from the go down, you guessed it, you have to reverse that input GST. The supply chain broke, meaning the government won't get their final output tax, so they take back your input credit. Let's ground this with a real-world scenario. Imagine you purchase some goods, but upon delivery, you realize the quality is totally subpar. You complain, and the supplier gives you a rebate of, say, 5,000 rupees to settle the issue. Because this rebate logically reduces the original cost of your purchases, you can't keep the original tax credit. You must proportionally reverse the input CGST and input SGST you initially claimed by crediting them. Input GST is always claimed only on the finalized, reduced cost of the goods.
Now, hold on. Here is a rather tricky scenario where a lot of people slip up. Suppose you owe an agency 50,000 rupees, but you negotiate and you settle the account quickly by paying just 45,000 rupees in cash, securing a sweet discount of 5,000. Do we reverse GST on this discount? The answer is a big no. This is purely a financial settlement of an account. No physical goods were returned and no extra services were rendered. Because there's no underlying supply happening, no GST is levied or reversed on a basic cash discount. So don't just blindly pass tax entries everywhere. Always check the core transaction.
All right, take a deep breath. We have reached Section 5, the Grand Set-Off Rules. This is the absolute climax of our explainer.
This is the final boss fight before you pay the government at month end, and it's where most accounting errors happen. We have a highly specific, legally prescribed order for setting off our input tax credits against our output liabilities. Let's look at the flow. If you have an IGST liability, you first exhaust your input IGST. If you still owe money, you dip into input CGST, and if needed, finally input SGST. But pay close attention to the CGST and SGST rows. For a CGST liability, you use input CGST first, then input IGST. For an SGST liability, you use input SGST first, then input IGST. Do you spot a pattern? Or rather, what's missing?
What's completely missing is cross-utilization between state and center. This is the absolute golden rule of GST set-offs. Central tax credits, meaning input CGST, can never ever be used to pay off state tax liabilities, like output SGST, and vice versa. The center and the state keep their core revenues fiercely separate. Think of it like trying to use a discount coupon from one coffee shop at a completely rival coffee shop across the street. It simply won't work. To make your life easier, just summarize this chronological puzzle into 3 actionable steps for month end. Step 1. Always completely exhaust your input IGST first against your IGST liability. If there is a leftover balance, allocate it to CGST or SGST. Step 2. Utilize your input CGST against your CGST liability and push any remainder to IGST. Step 3. Utilize your input SGST against your SGST liability and then IGST. If you follow this exact flow, your balance sheet will match up beautifully every single time. As we wrap up today's explainer, I want to leave you with one final provocative thought. If all these businesses are constantly setting off their taxes and claiming input tax credits at every single stage of the supply chain, who ultimately bears the actual financial cost of GST in our economy? Think about it. Yes, it's the final consumer. It is you and me buying that finished product. We absorb the entire tax burden because we have no business output to set it off against. Fascinating, isn't it? Well, that is the true beauty and design of indirect taxation. Thank you so much for joining me in today's visualization. Keep practicing those journal entries, and I will see you in the next one. Bye-bye.